Hello, everybody, and happy Friday. You'll have to forgive me. I'm not on video today. I had a small surgery on my head, and I look like a car accident victim. So we don't want that. So this week, the Federal Reserve met on Wednesday, and as expected, they didn't change the Fed funds rate. And they gave some comments after, as they always do, and these are usually the most impactful things. And as they see things right now, the labor market remains strong. Although unemployment has moved up a little bit, it still remains low. In regards to inflation, they sort of walked back a little bit of their positivity from the last meeting and are saying now inflation has eased over the past year but remains elevated. So injecting a little bit more concern that inflation might still be a problem. We're going to talk a little bit more about that in just a minute and how that's being read and what might be happening in the not too distant future. So today, the Personal Consumption Expenditures Report came out. This is the Federal Reserve's favorite measure of inflation. The headline number was 2.6 year over year, and the core number, which strips out food and energy, was 2.8 year over year. Now, so what's really important to understand, and as real estate agents, you are always asked, as am I as a lender, what's going to happen with rates? Well, rates are going to come down. And they're going to come down this year rather significantly. How do you know that? Well, because interest rates always follow inflation, and inflation is going to come down. Well, how do you know that inflation is going to come down? Well, some things are speculative and other things we know factually. So on the speculative side, the Federal Reserve is using the Fed funds rate to keep the cost of credit higher so that people borrow less and curtail spending, thus cooling off the economy, so to speak. There's also the new administration that is saying that they're going to unleash energy, and if they do that, and if we start doing more energy production, making energy cheaper, then that will of course have a dramatic impact on inflation. But that remains to be seen. The next thing is, now this is where we get into the factual part. It's very important to understand that in the reading of inflation, 18% is shelter, and shelter is measured by rents and owner's equivalent rents, which is the amount that a homeowner could rent out their home if they did. And this is a very important component of inflation, but it's also a very problematic component because it's always about a year behind of what actual numbers are. So just to make the point, so right now with the reading that just came out today, okay, this shows that the core PCE is 4.98%. Okay, I'm sorry. Let me rephrase that. The shelter component of the core PCE was 4.98%. Okay, remember, shelter makes up 18% of the reading, but it's a year old. The actual shelter reading is only 1.5%. This data is readily available. These models for measuring inflation were created 50 years ago, before there was the internet and real-time data was available, and they're still following them, which is why there's always a lag, which is why we have these bust and boom economic cycles, because the Federal Reserve, as it's making decisions on inflation, is not actually dealing all the time with real-time data. But what do we know for a fact? What we know for a fact is that the shelter readings for February, March, April, and May look like this. So as you can see, it's next month is going to be less than half. And since shelter makes up 18% of the inflation reading, we will see a rather significant dip in the inflation report coming out next month. So the markets did not react negatively to the Federal Reserve not lowering the Fed funds rate. That was expected. And next month, when we start to see these much lower shelter component readings be factored into the PCE report, we should see a corresponding lowering of inflation as reported, which the bond market, which is where mortgage money comes from, will react very positively to that. And we should start to see some significant improvements in interest rates. Just to give you a little note, Barry Habib, who is the owner and president of MBS Highway, he's won the Crystal Ball Award 3 times. I don't know if that means anything to you or not, but he is pretty much one of the elite analysts that there is in the country, and he does have the president's ear, and he actually wrote a note to President Trump about this, explaining it and the flawed method that the Federal Reserve uses to measure inflation and suggesting changes. So we'll see if anything comes of that. So rates have remained unchanged more or less ever since we saw our big spike up, but they're still better. We're way below 7, well below 7 on some programs anyway. Conventional 30-year fixed at 6.875%, with government and jumbo loans down closer to 6. Also, in other good news, the Case-Shiller Home Price Index came out, and as you can see, it came up. Now, this is for November, I should say, so this is also a lagging indicator, but it increased 0.4% month over month and 3.8% year over year. So that is a good sign. Home values are holding and even moving up in some cases. Just more as a FYI, something that was of interest to me, the FHA serious delinquencies are significantly up. You can see, these are the various quarters starting in Q1 of 2020, going all the way through of Q1 of, we're currently Q4 of 2024. And these are the reasons that people say that they are 90 days or more delinquent on their mortgages. It ranges everything from unemployed, excessive obligations, death or illness, marital difficulties, etc. So in the last quarter of 2020, the people that were 90 plus days delinquent, only 1.76% of those said that the reason was due to being unemployed. In Q4 of 2023, 7.68% said that unemployment was the reason. And in the closeout of 2024, just last year, 12.07% said that the reason they were 90 plus days late on their FHA loans was because they were unemployed. Interestingly, excessive obligations has followed a very similar pattern, 2.71% at the closeout of 2020, 16.61% at the closeout of 2023, and 20.1% at the closeout of 2024. So people are having difficulty with jobs. They're getting in more and more debt. They have too many obligations. Apparently, people are also getting more and more sick, and they're fortunately, marital difficulties do not seem to be spiking up too much. So we want to walk away with something positive from all of this. But I point that out to you because keep that in mind as you're having conversations. Remind people that there are ways to mitigate this. There's loan modifications and other things they can do. They should contact their servicer. So any of your clients that might be experiencing this, please let them know help is available. They don't need to walk away from their home because homeowners have more equity than they've ever had in the history of their country. I'd like to ask a personal favor if I could. I'm working very hard to build my social media presence, growing it on YouTube and other social media channels. If you could, watch the video on YouTube, leave a like, make a comment if you're so inclined, and if you can, share the video with a friend or a colleague, a client, or a prospect. It would help me so much as I work to grow my business. So that'll do it for me today. Thank you so much. Have a wonderful day. Have a wonderful weekend. And we'll see you on Monday with part 2 of the impact of the second Trump presidency on the market. Take care.